All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Tuesday, everybody. Today is August 18th, 2026. And our top story this morning is quite similar to what we were talking about yesterday. Rising interest rates is all the rage this morning, in particular in the long end of the yield curve. Those long-term interest rates, the U.S. 30-year Treasury yield has hit 5.33% this morning. That is the highest since June of 2007, all the way back when those hedge funds at Bear Stearns were just starting to collapse. Long bonds the prices are getting a lot less expensive, and the interest rates are getting a lot more expensive. The 10-year yield right behind 4.74%. Not quite the multi-decade high. That's the highest we've seen since last year. But the further out you go on the yield curve, the more expensive it's getting to borrow. It's not just a U.S. phenomenon. It is everywhere in the world right now. So what is going on? Well, it's term premium, guys. Sticky inflation expectations. Everybody knows the governments are going to start printing again at some point. Everybody knows fiscal recklessness is all the rage around the world. And so they are demanding higher interest rates in order for locking up their money for multiple decades, because they say by the time I get my money back, it's probably going to be worth a whole hell of a lot less. And coincidentally, like we were talking about yesterday, there's also a hell of a lot of competition. You've got governments around the world are borrowing like crazy on reckless entitlement programs and runaway government spending. Also, World War III, kind of an expensive proposition. And on top of that, you've got the AI bubble that is borrowing every dollar, yen, kroner, and zloty in sight around the world. And so it's getting more expensive. If the governments want to borrow, they have to compete with AI companies now. And I tell you, Meg, that's in my show yesterday, I was just blown away by some of the numbers that are being thrown around for AI spending. More money than all the money in the world that they're borrowing. Case in point, this morning, we've got SoftBank is out with a $6.3 billion retail bond offering in Japan. That is actually the largest retail corporate offering in history in Japan. What's SoftBank going to do? They're actually borrowing yen. Well, SoftBank's going to borrow the yen. They're going to convert them to dollars, and they're going to give that money to OpenAI to spend on data centers. All right? It's the quintessential, like perfect encapsulation of what's going on in the economy here. You got the yen carry trade, you got the AI bubble, you got the rising interest rates. Masa-san is just like, give me more debt. I didn't lose enough money on WeWork. I must have more. Well, he's going to get it, apparently. Now, look, everybody in the world is increasing their government spending. Everybody except Greece, apparently, which, like, again, this decade, man, I don't know what is going on. Greece is actually one of the most fiscally responsible countries in the world now. They're actually operating with a budget surplus this year, as is Taiwan, which is pretty interesting because Taiwan just announced they're going to be giving out $330 STEMI checks to everybody in the country next year. They're calling it an AI dividend. If you're wondering where all your retirement money went after the bubble burst, that's where your money is going. But also, you got to wonder with these rising interest rates, what's going on at the banks? What's going on at the insurance companies? We talked last week about rising unrealized losses on bonds and Japanese insurers. I mean, interest rates are now considerably higher than they were when the banks failed in 2023. Gotta wonder, how far are we from some other story like that? Or maybe the UK pension system blowing up like happened in 2022 due to rising interest rates. We also, my friends Melody and Travis, we were talking over at Real Estate Mindset over the weekend about a big blow up at United Wholesale Mortgage because of wrong bets on interest rates and failed hedges that probably weren't really hedges. The guy just made one massive levered bet on interest rates. So we're starting to see problems developing from these rising rates in obscure corners of the economy. Got to wonder how long can it keep going on, because stocks just keep marching higher. They don't seem to care. Now, that other thing that stocks don't seem to care about is what's going on with energy and with fuel. In particular, crack spreads and diesel crack spreads, historic highs. Now, crack spreads, this is interesting. The crack spread is the price difference between a barrel of crude oil and a barrel of refined fuel like diesel, gasoline, or jet fuel. All right. By the way, jet fuel, we were running out of jet fuel. Remember, we were 4 weeks away from running out of jet fuel, and that was like 4 months ago. You don't hear that very much anymore. The doom around jet fuel has definitely subsided, but I digress. Crack spreads, historic highs. A barrel of diesel is now $100 more expensive than a barrel of crude oil. Now, this is important, guys, because what you pay at the pump is really what matters, right? Nobody cares about the cost of a barrel of oil. It's what does it cost for gasoline when I fill up my tank? Or what does it cost the trucker who is carrying the goods to Walmart that I'm going to buy? And what is he paying for diesel? That's what really affects you. Well, crude oil prices are going up because of what's going on in Iran and to a lesser extent what's going on in Russia and Ukraine. But we've also got crack spreads are rising. So as the oil is rising, the price of the refined fuels is rising even faster than that to a historic high above $100 a barrel for the first time for the price of diesel. Now, this is not just what's going on in the Strait of Hormuz. That is playing a role. It's not just about the tankers being unable to get out. It's about the attacks on energy infrastructure, the targeting of refineries, which the Ukrainians have proven very adept at blowing up Russian refineries. The Iranians have proven very adept at blowing up Bahrain and Qatar and Iraqi and Saudi refineries. All of these targets on energy refining infrastructure is leading to a shortage of refined fuel. And the United States, who has not built a new refinery in freaking 70 years, is trying to float the whole world by exporting refined fuel. And it's only going to get you so far. And that is why, even though the price of oil maybe came down quite a bit in June with the memorandum of misunderstanding, but the price of gas didn't go down, did it? Everybody notices the price of gasoline goes up a lot faster than it comes down when things settle down in the Middle East. Well, it's because those crack spreads are stubbornly high here. And again, you got to wonder, if diesel's getting so expensive, everything touches diesel, right? Construction touches diesel. All those bulldozers and excavators run on a lot of diesel. Hey, we're building all those AI data centers with those bulldozers and excavators. They're all installing diesel generators at those data centers, and they all run on diesel. That's interesting. And everything we buy in this store is brought there by a truck that runs on diesel. Farmers are getting ready to harvest here in the United States. They run on diesel. A lot of stuff is about to get more expensive because of this. Now, also on the energy angle, an interesting story this morning. Chinese shipping giants are halting oil tanker operations in the Strait of Hormuz and the Bab el-Mandeb Strait. Drink, says Sal Mercagliano. Yeah, I have questions about that. I thought the Chinese were cool with the Iranians and the Houthis. I thought their boats could get through. Why are they suspending operations? I have questions. All right, also going on this morning, we've got Home Depot has posted earnings. The stock is up after reaffirming guidance. Their earnings per share beat, but that's mostly being driven by tariff refunds. Turns out the tariffs that were collected last year were really just a handout to companies because, they charged the tariffs to the consumers and then they were ruled unconstitutional. The government had to give the money back. You think Home Depot's giving the money back to their customers? Oh, no, silly rabbits. That's going right into earnings per share. But also the comps at Home Depot, they're improving, but they're still pretty terrible. Housing market remains frozen, but a lot of that doom and gloom was already built into the share price of Home Depot, which has lagged the greater market considerably over the last few years. So those shares are rallying a little bit this morning. And then we've got Klarna, the buy now, pay later firm. They are being taken to the woodshed this morning, down more than 20% after they cut their revenue guidance. Now, their CFO is leaving and their chief marketing officer is leaving. That's interesting in and of itself. But in particular, they're calling out Germany, which is Klarna's biggest market. They're saying volume issues in Germany are a problem. And that kind of caught my attention because my moderator, Mish, spotted this story about German companies shutting down at an alarming rate. In 2025, 190,000 German companies stopped operations. That was up 10% year over year. And it's not insolvency that's putting these people out of business. It's actually worse than that. It's kind of sad when you think about it. Stick around to the end of the show for that one, man. What is going on in Germany this morning? Guys, we got a lot to talk about. Let's shrink my big melon of a head and let's see what's going on in the world of finance. Don't forget all that algorithmic goodness, the like button, the hype button, all that good stuff. Should you feel so inclined, and hey, the subscribe button's right next to those two. Right now, the S&P 500 is lower by 35 points, 0.45% in the red. We've got the Dow is off 41 points, faring a little bit better, 0.08% in the red. But the NASDAQ is getting the worst of it this morning, off by 1.3%, 390 points lower in the NASDAQ. Those debt-heavy, debt-reliant AI companies not liking the blowout in long-term borrowing costs this morning. Meanwhile, the DXY is pretty much unchanged here at 99.60. That's higher by about 3 basis points. Looking over at Bitcoin, we are down by $355 here, relatively unchanged, $64,128 for Bitcoin as priced on Coinbase. Bitcoin did have a pretty good day yesterday. It rose by about $1,500, giving back some of those gains now this morning. Looking over at commodities, we have got metals are not liking these higher interest rates here. Spot gold is off by $22 this morning, $4,395. Still hovering around that 4,400 mark, all things considered, not bad for spot gold. Spot silver is at $65.13. That's lower by about 65 cents or 1% in the red, but I still like the shiny. We've got copper is down by 1% and change. Platinum is lower by 2%. Palladium is lower by almost 2%. And crude oil is a little bit higher here, $84.39 a barrel for October WTI crude. That's higher by about 65 cents or 0.75% this morning. No real major developments in the Middle East to discuss this morning, though. But it's those interest rates. Now, they're off their highs of the morning, but they are at multi-year highs. The 30-year Treasury, 5.318. That's higher by almost 1 basis point here. At one point this morning, it was at 5.335, which, again, we'll show you in the chart, the highest in quite some time. The 10-year yield is up by a point and change at 4.736. Intraday high of 4.747. We did not spend very much time in the 4.6 area. Now we're into the 470s. The 2-year yield is at 4.192. That's higher by 1 basis point. And the 1 month is unchanged at 3.696. So let's talk about this one. Global bond slump sends long-term borrowing costs to highest in decades. In decades. Yikes. Longer maturity bonds are at the epicenter of investor angst about everything from inflation to the debt-laden artificial intelligence boom, and governments are paying the price. Sovereign borrowing rates are surging around the world. Yields on 30-year U.S. Treasuries rose to the highest since 2007 this week, while French borrowing costs hit the loftiest since 2008, and their German peers traded at 2011 levels. Equivalent gilt yields in the UK are approaching 6%, and similar maturity Japanese ones are close to their all-time high. Now, the Japanese yields are considerably lower than the rest of the world because of modern monetary theory in Japan, but approaching an all-time high in Japan. So relative to what Japanese yields have been, they're going crazy over in Japan. While domestic factors have a role in each market, the structural forces driving up yields are global in nature. And that's important, guys. This is everywhere in the world. One fear is that persistent geopolitical turmoil will make economies more prone to supply shocks and inflationary pressures. Bondholders are also worried that governments will fail to rein in spending and pressuring fiscal health. I don't know where people got that crazy idea. I mean, when's the last time you heard anybody in Washington talk about cutting spending? I mean, we had this sideshow. We called it Doge last year. We cut a couple of things. We patted ourselves on the back, and then we're like, onward to $2 trillion deficits. Yeah, I mean, besides Rand Paul, is anybody out there talking about spending cuts anymore? No, nobody, because they were never serious about them to begin with. Meanwhile, changes in market structure and demographics are resulting in waning demand from once steady buyers. That's important too. You've got a shift in who is buying a lot of this debt. What the market is saying, we expect greater inflation or at least greater uncertainty in the future, and therefore we demand higher yield for longer bonds, said Justin Onukwusi at St. James Place. I'll buy it. Government costs are rising across global bond curves, but long maturity debt is most sensitive to fiscal matters given its yields most often is highest. The concern is significant enough for nations to skew sales away from longer dated bonds towards shorter tenors. In the UK, authorities have ceased most scheduled long-dated sales. Governments have only limited room for maneuver, though, as they adjust to a world where they can no longer lock in financing costs for decades at rock-bottom rates. Now, that is something that Janet Yellen started here in the States. She started issuing fewer long bonds and way more treasury bills. A lot of people self-included, called that stealth yield curve control. And then Scott Bessent came in, and Scott Bessent just took that and he ran away with it. I mean, they are issuing way more T-bills, than long-term Treasury bonds here in the U.S. now. To the point, it's in the hundreds of billions. Fewer long-term Treasuries are being issued versus Treasury bills. And of course, the AI bros just came in and they made up for that, and they're borrowing up all that extra hundreds of billions in long-term debt to make up for what Scott Bessent is not borrowing. Let's see what we got here. The Treasury market is just one part of the story. The average yield on a benchmark portfolio of investment-grade government bonds has surged to almost 4.5%, the highest in data compiled by Bloomberg going back to 2015. Global debt markets have been battered this year by surging energy prices caused by the conflict in the Middle East, which has fueled bets the Federal Reserve and other central banks will tighten monetary policy, although those risks of the central bank tightening have waned somewhat over the last 2 weeks since we got some weak employment data 2 weeks ago and then weak inflation data last week. Rising interest rates will add to the challenging fiscal backdrop of the world's major economies. In the U.S., interest on the public debt continues to be a key driver of the nation's growing budget deficit. For the fiscal year to date, the tally is $1.17 trillion. Oh, and it's only August. That's a 15% increase, thanks in part to higher yields on treasuries. But the challenge for fixed income investors predates that, and recent price action suggests other factors are helping to drive long-dated yields higher. One element acting as a headwind for longer maturity government debt globally is competition from corporate borrowers. A record pace of bond issuance has added substantial duration supply to the U.S. fixed income markets, especially as tech firms looking to finance AI investment seek to borrow at longer maturities. That amazes me, by the way. How are these companies borrowing for 30 years to buy GPUs that are going to last 5? I don't understand that, but hey, good luck with that one. These U.S. firms are increasingly tapping overseas bond markets, with one example being Alphabet's decision to market a debut Australian dollar debt issue of 5 billion Australian dollars. And that last sentence there is important. Google borrowing money in Australia because they've already borrowed everything they can borrow here. Then they went to Norway for a little while. They borrowed some in Japan. Now they're borrowing in Australia. They're borrowing everywhere to pay for this data center build out. And let's look at the result of that. This is the U.S. 10-year yield. And I've shown this chart quite a bit here. You notice we broke out of this flag pattern that we had been in since hitting the high in 2023, October of 2023. That's when the 10-year yield hit its highest level in several years. It broke very briefly above 5% before selling off, and we've been kind of consolidating since. But then in July, we broke out of that consolidation pattern, and now we're grinding higher. We're only a few points off the highs from January of 2025. And I've shown this chart a couple of times. I'm going to change this now to monthly candles. And here, let's set this to a line chart so you can see it a little better. This is what I think people need to realize. All these finance bros, everybody who's like, don't worry, guys, the Fed's going to do what they always do. They're going to cut rates. They're going to print money. That may not be working anymore. And this is so important. Everybody in the world is operating under the assumptions that were formed by this experience, by everything that the Fed has done since Nixon closed the gold window. Since the end of the inflation shock caused by Nixon closing the gold window, right? Everything since Arthur Burns at the Fed. Since 1980, 81, interest rates have done nothing but go down. Every time there's a crisis, they print, they cut, and it solves the problem. Well, look, in 2020, things got just so wacky, so out of hand with the money printing that it caused a unanchoring of inflation expectations, that boogeyman that Jerome Powell was so afraid of. And ever since then, interest rates have been going higher. And there you can see that consolidation pattern, which we have just broken out from. Interest rates are going to continue breaking higher. And I believe the next 40 years, or I should say the next 35 years now, are going to look more like they did in the aftermath of World War II, with steadily rising interest rates. And you're probably sitting there saying, Jack, the governments can't afford that. They're $30 trillion in debt. I know. That's the problem. And I don't think they can control it because the Fed hasn't been hiking this whole time. And yet the interest rates are rising anyway because people know inflation is now out of the genie's bottle and there's no putting it back in. And so the Fed doesn't control long-term interest rates. They can print money and buy those bonds, and they can drive their yields a little bit lower in the short term by bidding up the prices. But the act of printing money is going to convince people that the Fed is not serious about fighting inflation. And then once that initial QE cycles through the system, those bond yields are going to go right back where they were and even higher, just like they're doing in Japan right now. And nobody alive is ready for this because everybody that's running things at financial firms grew up and studied this. They've never seen this. And unfortunately, I think we're heading for this again. And by the way, that chart began in 1941, I should say, and it ran until pretty much 1981. All right, also the 30-year yield. Let's talk about that because that's the one that's really rising. Again, these are monthly candles, 5.32% now on the 30-year yield. The last time we were at this level was here in June of 2007. Fun fact, that's the month those two hedge funds tied to Bear Stearns went under, ultimately triggering the onset of the great financial crisis. Before that, the last time our yields were in this neighborhood would have been April of 2004. They were only a little bit higher back then. Guys, interest rates appear to be moving higher. And shout out to Robin J. Brooks on X, who posted this one. Long-term government bond yields are pushing up to new highs everywhere, not just in the U.S. What sticks out like a sore thumb is Japan, extreme example, where the break in the long end of the yield curve is extreme. But many other places, the U.S., the U.K., France, don't look great either. And look, this chart, I mean, the blue line is 10-year, the red line is 10-year forwards. Just suffice it to say, interest rates. You get the same chart pretty much everywhere in the world. U.S., Germany, Japan, U.K., Italy, France. Switzerland, not so much. The one exception there, they're rising, but very slow in Switzerland. But also notice in Switzerland, their rates are basically zero. They've got pretty much negative real yields in Switzerland. That's going to cause other problems for them. Italy, same thing. France, same thing. Interest rates are rising everywhere. And again, one of the reasons why is because of the AI build out, and they're borrowing all the money in the world. Here we got SoftBank plans $6.3 billion bond sale to retail investors. This is another one. SoftBank has been borrowing all year, just giving the money right over to OpenAI. SoftBank is preparing to issue bonds worth approximately 1 trillion yen. That's about $6.25 billion US, targeted at retail investors in Japan, Nikkei reported on Tuesday. The planned bond sale would mark the largest retail bond offering ever by a Japanese company. The company has been increasing its investments in AI businesses and has used loans, bonds, and asset sales as funding sources for these initiatives. In particular, OpenAI or SoftBank has just been handing this money off to OpenAI. So here we go. The biggest, if completed, this would be the biggest retail bond offering in history, so they can convert it to dollars and pump it right into the AI bubble here in the States. This is the personification of the yen carry trade. Taiwan, meanwhile, Taiwan's got plenty of money. Taiwan to give every citizen $330 as AI boom fuels record growth. When you're wondering in a few years from now or a few months from now, after the AI bubble bursts, and you're wondering where your money went, this is where your money went. Aims to distribute before the Lunar New Year in February, sharing the fruits of economic growth with citizens in the debate over populism ahead of elections. Taiwan's government will hand every citizen 10,000 new Taiwan dollars, it's about $330 US, in cash next year, aiming to share with the public the gains from faster than expected economic growth driven by a boom in AI and semiconductors. President Lai Ching-te announced the cash payment plan after receiving a report on the 2027 central government budget proposal from the executive yuan at the presidential office the previous day. Lai stressed that the Taiwan economy is growing rapidly as global demand for AI, high-performance computing, and cloud services surges. He explained the aim, saying the growth forecast had risen sharply on the strength of Taiwan's accumulated competitiveness in semiconductors, IT, and manufacturing supply chains, and that he would ensure all citizens could share in the fruits of economic growth. And look at these GDP numbers. According to the latest projection from Taiwan's Directorate General of Budget, Accounting, and Statistics, the island's GDP is expected to grow at 11.05% this year. That is more than a percentage point higher than the previous forecast of 9.64%. And if realized, it would mark the highest annual growth rate in 39 years. Growth in the first half of this year also reached 14.15%, the highest level in 50 years. Guys, this is where all the money's going. All this amazing spending on AI CapEx and all of NVIDIA's earnings, it's all being funneled one way or another into Taiwan Semiconductor. and onto this little island that is now seeing 11% GDP growth. And so everybody on the island gets $330 courtesy of your 401k, which is where all these AI bros are currently borrowing the money from in order to pay for this build out. So yeah, this is your money and it's being replaced with an IOU from companies that don't make money. We talked all about that yesterday. Good God. All right, now on to fuel. U.S.-Iran tensions push oil prices higher as diesel margins hit records. Declarations by Iran and the U.S. earlier this week make the prospect of peace in the Middle East even more distant, driving crude oil prices higher. Meanwhile, the diesel crack spreads in the U.S. topped $100 per barrel for the first time in history. At the time of writing, Brent crude was trading at $91.33 a barrel, and West Texas Intermediate at $85.08 a barrel after Iran said it would adopt a fully offensive strategy in the war with the United States, as negotiations have consistently failed to achieve an end to hostilities. That can't be right. I've been told we're an hour away from a deal for the last 3 months. While the rhetoric between the U.S. and Iran hardens, the crack spread for diesel in the U.S. refiners surged above $100 per barrel, illustrating a deepening supply crunch for the fuel resulting from the Middle Eastern war. Again, crack spreads is the price difference between a barrel of crude and a barrel of refined fuel. In this case, a barrel of diesel is $100 more expensive than a barrel of crude oil. That is the profit margin that the refineries are making. The crunch is global, with the International Energy Agency reporting earlier this month that global refinery run rates stood at 80.9 million barrels per day, down 5 million barrels per day on the year. That is important. All right, it's not that there's a shortage of oil, guys. There's plenty of oil. It's just in the wrong place, and we can't get it to the refineries, and the refineries are blowing up. That's also a very big problem, the refineries blowing up. 5 million barrels a day less getting refined. Diesel production has been hit especially hard as refiners ramped up gasoline and jet fuel production earlier in the summer in response to peak travel season. Yet the crunch was made a lot worse by Ukrainian drone attacks on Russian refineries, as the country is a top 3 exporter of fuels. In response to those attacks that caused fuel shortages, Russia banned diesel exports until the end of the year. And that has caused fuel shortages all over the world that the U.S. is trying to make up for. We got a little bit more on that in the Wall Street Journal here. Diesel buyers compete for shrinking supply pool. American refiners are supplying a global market that needs more diesel just as their own inventories are running unusually low. Diesel buyers are competing for shrinking supply amid disruptions in Russia and the Middle East, with the U.S. at the center of a scramble that could intensify into the winter. The squeeze across the global refined product markets, where gasoline, diesel, and jet fuel compete for the same refinery capacity, is pushing prices higher. The benchmark price for European diesel hit $167 a barrel late last week, compared with $87 a barrel a year earlier. Okay, a slight year-over-year increase there it's not even 100%. Come on. That's according to data collected by price reporting agency OPIS, which is owned by Dow Jones. The diesel crack spread in Northwest Europe, the premium of diesel over crude, was around $90 a barrel on Friday, compared with an average of $24 a barrel last year. And since then, that was the number on Friday. That is now over $100. So running short on diesel. And guys, it's important to note, diesel touches everything, right? Everything you buy is either works in a factory where you got diesel generators running, or it gets loaded onto a truck that's powered by diesel, or it's grown in a field where a diesel-powered tractor harvests it, or maybe you're one of these AI bros and you're looking at Caterpillar and John Deere stock ripping because, well, they're buying all these diesel generators from those companies to power data centers because the grid can't keep up with it. What do those run on? Diesel. So, yeah, that's things getting more expensive. This is future inflation here. All right, and this story, I got to admit, this one in cryptobriefing.com has me scratching my head. Chinese shipping giants halt oil tanker operations in strategic straits. Chinese shipping giants Costco and China Merchants Energy Shipping, or CMES, have ceased oil tanker operations through the strategic choke points of the Strait of Hormuz and Bab el-Mandeb. This development comes amid rising tensions in the region, where a fragile ceasefire between the U.S. and Iran has been under strain. The decision by these leading Chinese firms suggests heightened security concerns, reflecting the ongoing volatility in the area. The cessation of operations in these critical maritime corridors is likely to impact global oil supply chains and has implications for market confidence regarding the return to normalcy by the end of September. Okay, so I've got questions here because I thought the Chinese were cool with the Iranians and with the Houthis, right? Remember when the Houthis were blowing up ships? The last time the Houthis were blowing up ships, they started in the fall of 24 all through 25. All these Chinese boats going through the Bab el-Mandeb were writing China vessel, don't shoot in their AIS data like, hey, I'm Chinese, blow up the Americans and the Israelis, not me. By the way, F you very much for that. But yeah, I thought they were cool with the Houthis. And then all these memorandum of understandings and the Iranians and the Omanis are talking about the toll booth. One consistent thing has always been there is that the Chinese don't have to pay the toll. At least that's what they've been saying. And from what I understand, the Iranians have been avoiding shooting at Chinese ships. So why would the Chinese ships stop going through these straits? Maybe the Chinese are worried that the Iranians don't know who they're shooting at and that they're just firing blind, right? Their GPS scramblers are going wacky all over the strait. You've got ships are turning their transponders on and off, spoofing them, trying to sneak through. So maybe they're worried about Iranian missile batteries with itchy trigger fingers, and that's why they're doing it. Or maybe, again, the Chinese are just tapping into geopolitical headlines in order to cover up the fact that oil demand is way down domestically. That's a question, all right? It's a theory that I have. I don't have any proof of it. But the fact that the Chinese are like getting down and helping with less oil imports than they would normally import, when the Chinese would typically do anything in their power to inflict more pain on the United States, why would they be helping by importing less oil? I don't get that. Maybe the demand picture in China is worse than they're letting on, or maybe they're just worried that the Iranians are going to shoot at everybody. I don't know. I've got more questions than answers on this one, but this one jumped out at me this morning. All right. Meanwhile, we've got Home Depot reaffirms guidance amid frozen housing market conditions. Home Depot on Tuesday reported fiscal second quarter results that beat expectations on top and bottom lines and reaffirmed their full year fiscal guidance. We continue to operate in what I call frozen housing market conditions, but we also know that we're taking share and that we're serving our customers better every day, CFO Richard McPhail told CNBC. Okay, so let's talk about the earnings. We've got EPS of $4.92 versus $4.73 expected. That's a beat. Revenue of $47.86 billion versus $47.27 billion expected. Also a beat. You'll see that those numbers really aren't as good as they seem. The home improvement retailer reported net income of $4.77 billion or $4.79 a share, compared with $4.55 billion or $4.58 a share a year prior. Excluding one-time items, Home Depot reported adjusted earnings of $4.92. Home Depot saw comparable sales rise 1.7%, beating expectations that they would be up 0.9%, according to the street account. All right, so that's actually kind of terrible there, right? 1.7% comparable sales. That's right. The same store has been open more than a year. What have their sales done in nominal dollar terms versus a year ago? They're up 1.7%. Well, inflation is a hell of a lot higher than 1.7%, which means they're selling less stuff. Now, 1.7% is better than the 0.9% that was expected. So, yeah, it's dreadful, but it's not as dreadful as we feared. And so this is interpreted as good news. And you've also got this other point here. McPhail said that it's the highest comparable sales number the company has posted since the third quarter of 2022. Okay, so that's important there as well, because number one, they've been really bad for a long time. Home Depot has been lagging the market for years. The housing market has been frozen for years. The next thing there, the 1.7% is the best number we've seen since 2022. Okay, so they're still dreadful. They're still not keeping up with inflation. We haven't kept up with inflation for 3 years, but they're improving. And the market is zeroing in on that but they're improving thing. 4 years now of consistently below inflation comparable sales increases. Home Depot is literally frozen in place. Home Depot also reaffirmed its fiscal 2026 guidance, which it said includes tariff refunds that are expected to partially offset unplanned fuel, energy, and other product input costs. McPhail added that the tariff refunds allow the retailer to maintain value despite cost pressures in other areas. All right, so their numbers are being artificially jimmied higher by the government giving back the tariffs. All right, and you're going to see that in a lot of retailers, a lot of importers are going to see one-time items from tariff reimbursements increasing their earnings per share. That's also one of the reasons why the July federal government budget deficit blew out so much. The company expects total sales growth for the year to be between 2.5% and 4.5%, and operating margin between 12.4% and 12.6%. Home Depot stock, it was positive. It was up by like 2.5% this morning. They must have said something on their earnings call. I don't know what that was, but all of a sudden they have swung to a loss, now down 1.5% at the open, $332.86. That's interesting. It was a good morning until I opened my big mouth. All right, now we got to talk about Klarna. Klarna is having a rough morning here. Klarna cuts revenue guidance as it widens user offerings. Klarna cut its expectations for how much revenue it will generate this year, citing foreign exchange pressures and volumes in Germany. Put a pin in Germany, even as it reported a profit beat for the second straight quarters. The payments firm said in a statement that it expects between $4.08 billion and $4.16 billion of revenue this year, down from about $4.3 previously. All right, so big bad growth company Klarna, revenue heading in the wrong direction, no longer a growth company. Klarna said it had taken a more measured view of activity in Germany. There's Germany again, its largest market by volumes. Shares dropped as much as 26% in pre-market trading in New York. Yikes. Klarna recorded $9 million of net income for the 3 months through June, beating an $18 million net loss that analysts had expected. So it was a big earnings beat. Revenue of $1.04 billion was up roughly 27% from a year ago. The company also announced that Chief Financial Officer Nicholas Neglin would be stepping down in early 2027, and the search for a New York-based CFO is underway. All right, CFO leaving the company on a bad earnings report. Bad sign for the company here. He'd been in the post for 6 years. Klarna also said their Chief Marketing Officer, David Sandstrom, would be replaced next year after 9 years at the company. So we got some C-suite changes happening amid some bad earnings and this problem in Germany. All right, Klarna, off the lows of the morning. It's down 19% and change here. It was down more than 26% at one point. $15.81 for Klarna, down $3 this morning. Over the last year, Klarna has shed 57%. That's since going public back in September, losing more than 50% since then. Yikes. So we got to talk about Germany, though. Look at this one here. More German companies are closing down due to economic headwinds. I was pretty surprised by this one. A greater number of German companies closed shop last year, and another sign of how challenging conditions and an aging society are taking a toll on Europe's biggest economy. I would have guessed insolvency and bankruptcy was the big driver here, but it looks like that aging society is the big factor in what's going on in Germany. Almost 190,000 firms ceased operations in 2025. That's up about 10% from the previous year, and the second significant annual increase in a row, according to calculations by ZEW Institute and Credit Reform, a Creditors Protection Association. Only every 8th case was down to insolvency. That's important, guys. 190,000 companies shut down in Germany last year, and only 1 in 8 was because they went bankrupt. With more and more firms shuttering due to reasons including skilled worker shortages, high costs, and lack of people willing to take over. The renewed rise in the number of business closures shows that the pressure on the German economy to adapt has continued to increase, CEW researcher Sandra Gottschalk said. Demographic trends are becoming increasingly significant. More and more companies are closing because their owners are retiring and can't find successors, even though these companies would otherwise be viable. And man, that just makes me want to bawl my eyes out. Good God, they're shutting down their businesses because they either didn't have kids or the kids they did have don't want to run the family business. Either way, that is really sad. 190,000 firms, only 1 in 8 went bankrupt. Continued headlines about job cuts in the flagship car industry, driven in part by fierce Chinese competition, are a factor that continues to weigh on the mood. However, the economy has also been plagued by low water levels in the Rhine and a spike in energy costs triggered by the Iran conflict. While 11,000 industrial firms shuttered last year, the figures show that economic weakness extends far beyond that sector, with hospitality and health also increases topping 10%. They're talking about hospitality and health companies shutting down was up by more than 10%. Large companies and corporations are currently dominating the news, said credit reform spokesman Peter Ludwig Hansch. However, the number of small and medium-sized businesses that are quietly disappearing is many times greater. Man, that kills me. Small, medium-sized businesses shutting down because they can't find anybody to take over when they retire. And it's so much so that it is leading to this headline in Klarna cutting their revenue guidance and seeing a 20% decline in this buy now, pay later company because all these businesses in Germany are shutting down because nobody wants to take over and run. And look, guys, the aging demographics, that is hardly a German problem. It's particularly potent in Germany for whatever reason. But we have that in the U.S., partially offset by immigration, which is now negative, so it won't be offsetting it much more. And this is really a big problem in Asia, in China, in Taiwan, in Japan, South Korea, the worst fertility rate in the world at 0.08 children per woman. That is less than half of the required number in order to keep a stable population. So again, go all the way back to that chart about how for the last 40 years, interest rates have been falling and everybody's basing what they think is going to happen on their lived experience of the prior 40 years. When I think it is different this time, there's that phrase. It seems that COVID changed everything and interest rates are now heading higher and they're heading higher. And maybe one of the reasons is this demographic collapse, because as demographies collapse, you end up with more people on the extraction side of entitlement programs, right? You've got an aging population. You got more people on Medicare, Medicaid. You got more people on Social Security pulling out of the system. They didn't have enough kids, and so there's fewer people paying into the system. The governments will make up for that with debt, and so they are going to borrow more and more money from a shrinking investor base because you got fewer people working. And then, that leads to decades of higher interest rates. Because birth rate trends don't turn on a dime. They don't change because you had an election and everybody's like, yeah, let's get in bed and make a baby. That'd be a very weird reaction to a political campaign, by the way. But hey, whatever does it for you. Either way, guys, the lesson is clear here. It's time that we all drink up and start making bad decisions. The fate of the world depends on it. Hey, I just want to say, everybody, thanks for having your coffee with the Melon Heads this morning. Don't forget all that like button, hype button, subscribe button, all that good stuff. Thank you very much to my Patreon members, YouTube members, and Buy Me a Coffee members for supporting the channel. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.